You're about to hear something that sounds like it belongs in a spy thriller, except it's happening in plain sight. Not on a conspiracy forum, not in some leaked document that will mysteriously disappear. Out in the open, quietly documented, and almost completely ignored. While most people debate distractions, one buyer has been stacking physical gold at a scale that makes entire nations look like they forgot the rules of money. And the wild part is this: it's not just one buyer, there are two. Two whales, moving quietly, positioning early, building leverage before the crowd even understands what game is being played. Before we name names, let's start where the story becomes impossible to dismiss. Price action and flow. Gold has been on a tear, the kind of move that usually takes a year compressed into weeks. Silver is even more violent, snapping higher in a way that forces you to ask whether the market is repricing the metal itself or the entire world it lives in. When metals move like this, it's rarely because your neighbor bought a few coins. It's because somebody with size, patience, and a long-term plan is pushing the demand curve into territory supply can't calmly meet. Now, I'm not asking you to blindly believe a dramatic narrative. I'm asking you to look at incentives, positioning, and who benefits from being early. Because early movers in capital markets don't shout. They don't live stream their strategy. They accumulate first, then they explain later, if they explain at all. That's why mainstream coverage often arrives after the real opportunity has already moved. Not because reporters are evil, but because big shifts are uncomfortable. They threaten the familiar stories people are paid to repeat. The most profitable transitions tend to look unnecessary right up until the moment they become obvious. Here's the mental reset you need. There are roughly 195 countries in the world. Not all of them hold gold reserves. In fact, a surprising number hold none at all. 0. No bar stacked in a vault. No national insurance policy sitting in a basement somewhere. And some of the countries you'd assume would be loaded with gold, wealthy, stable, resource-rich, are among those with little or none. That isn't a moral failure, it's a choice, a bet on a certain kind of world. Take Canada, for example, a country known for mining, with major gold companies and a deep connection to precious metals. Yet its official reserves of gold have been reported as essentially 0. Other advanced nations have also reduced their holdings over the years. Some sold in periods when gold was treated as a relic. Their logic sounded rational. Modern finance is sophisticated, currencies float, bonds yield, and trust in large institutions is stable. In that framework, gold can look outdated, like a museum piece. Why store bricks of metal when you can hold productive assets, earn yield, and rely on the system? But history has a way of humiliating confidence. Gold tends to become relevant again right when people least want to talk about it, because gold is not just a commodity. It's the asset that sits outside the promise system. A bond is a promise. A bank deposit is a promise. A government currency is a promise backed by laws, taxation, and credibility. Gold is different. It doesn't require anyone to keep their word. That is why, when uncertainty rises, gold stops being barbarous and starts being boring and necessary. It becomes the thing that still works when trust gets messy. Now here's where the story sharpens into something most people can't ignore. There is a first whale, an entity that has reportedly accumulated around 140 tons of physical gold. Read that again. Physical. Not a paper claim, not a derivative, not an ETF share. Metal that has to be dug out of the ground, refined, assayed, transported, and stored. 140 tons is a number that forces you to compare it to national holdings. It's enough to sit at the same table as countries. It's enough to surpass the reserves of many states that you assume are serious about wealth preservation. So who is it? It's Tether. Yes, Tether, the company behind USDT, one of the most widely used stablecoins on the planet. Even if you've never touched crypto, you've indirectly felt its influence. USDT is used to move value across borders quickly, to settle trades, to park funds in something that behaves like a digital dollar, especially in places where banking is unstable or access is limited. It's a bridge between the old financial system and the new one, whether you like that or not. Think about scale for a second. When a stablecoin has tens of billions, now well over 100 billion units circulating, it starts to resemble a private monetary network. In practice, it becomes a massive pool of short-term liabilities that need reserves behind them. Traditionally, reserves are things like cash, treasury bills, and other highly liquid instruments. But Tether has also been building something else, a growing stack of gold. And the language coming from leadership has been revealing. Not, we bought some gold as a hedge, not a small allocation. More like, we are positioning ourselves to be a major gold holder, potentially functioning like a kind of private sector central bank for a new monetary layer. That isn't casual phrasing, it's a signal. When someone with that kind of balance sheet starts describing their role in those terms, you should hear it as a strategic declaration. They are planning for a world where trust fragments and collateral becomes king. Now, The next detail is what turns this from interesting into why isn't everyone talking about this? The storage. Because if you're going to accumulate physical metal at scale, you need secure custody. And according to multiple reports and interviews, some of this gold is stored in Switzerland in high security facilities that have the vibe of Cold War infrastructure. Fortified, discreet, designed with worst case scenarios in mind. Think thick steel, layered security, and the kind of place you'd pick if your assumption is that stability is not guaranteed forever. So ask the question that matters. Why would a major issuer of digital dollars want that much gold? One answer is straightforward: diversification. Another is more strategic: credibility. In a world where people question fiat stability, gold acts like an anchor. If your product is a dollar you can use anywhere, and people start doubting the dollar's future purchasing power, your incentive is to build reserves that survive reputational shocks. Gold doesn't depend on any one government's policy choices. It is the universal collateral that every culture recognizes, even if they don't love admitting it. But there's a deeper layer. The leadership of Tether has openly discussed the possibility that geopolitical competitors of the United States could push harder toward alternatives to the dollar system. If that happens, whoever can provide liquidity, settlement tools, and trusted collateral may become extremely powerful. In that world, gold is not a decorative hedge. It's a strategic resource. It's the metal that can settle accounts when paper promises become politically dangerous. And that brings us to the second whale, the one that makes the first look like a warm-up act. The second whale is not a company. It's a block of states, BRICS: Brazil, Russia, India, China, South Africa, and now a growing circle of partners and entrants, depending on the year and the political momentum. Regardless of the exact membership list at any moment, the concept is clear. Large non-Western economies coordinating more closely, especially on trade, finance, and strategic autonomy. Together, this cluster represents a massive share of global population and a significant slice of global output, commodities, and energy flows. In other words, it represents real weight, the kind of weight that can bend global systems over time simply by choosing different defaults. Now zoom in on gold. Over the past several years, central banks have been large net buyers of gold. That is a real measurable trend, and it has been a major tailwind. But within that trend, BRICS-related buying has been a dominant force. The official figures show large increases in reported holdings for some of these countries, with constant speculation that actual accumulation may be higher when you include off-balance sheet activity, domestic production absorption, and other mechanisms that don't always show up neatly in public numbers. China's official reserves have risen, Russia has built significant holdings over years, and India continues to accumulate. When you add it up across the bloc and its key participants, you're talking about thousands of tons, not hundreds. Thousands. That is not a trade. That is a strategic shift. And here is the part that turns this from a metal story into a monetary story: the settlement layer. The big talk for years has been de-dollarization. Many people rolled their eyes at it because the dollar remains dominant in many areas: invoicing, reserves, global financing. And it's true that replacing the dollar overnight is unrealistic. But the real story is not overnight replacement. It's gradual bypass. It's parallel rails. It's countries reducing dependence where they can, especially in bilateral trade, energy transactions, and regional agreements. We've already seen major trade relationships shift toward local currency settlement. When large economies settle more of their trade in their own currencies, they reduce the need to source dollars and the need to hold as many dollar assets as buffers. That change is slow until it isn't. It compounds quietly and becomes obvious in hindsight. Now, there have been discussions and pilot concepts connected to BRICS about creating a trade settlement unit or mechanism that relies less on the dollar. Some versions involve baskets of currencies. Some include commodities. Some include gold. The common thread is obvious. If you want a neutral settlement reference that doesn't rely on U.S. controlled plumbing, gold is the traditional candidate. It is no one's liability. It doesn't come with sanctions risk in the same way a bank account does. And it has a history of being accepted across borders when politics gets tense. So when you hear claims that a new trade settlement unit could be partly linked to gold or structured around commodity backing, you should not dismiss it as fantasy. You should interpret it as experimentation by major actors who have strong incentives to reduce vulnerability. They don't need to win immediately. They need to build options. Options are power. Now connect the two whales. A private issuer of digital dollars stacks gold and talks, like it wants to be a central liquidity hub for a new era. A bloc of nations stacks gold and explores settlement systems that reduce dollar dependence. These are not contradictory moves. They are compatible. They can even reinforce each other. One provides market infrastructure, the other provides geopolitical momentum. In that scenario, gold becomes the shared language of trust. That should make you pause, because it reframes what you thought gold was. Most people still think of gold as an old person's investment, a dusty hedge for pessimists. But the biggest buyers are acting like gold is strategic collateral for the next phase of global finance. That's not nostalgia, that's cold calculation. Now we have to talk about silver because silver is where narratives break and asymmetry appears. Gold is the headline metal. It's what central banks talk about. It's what people wear. It's the symbol. Silver, on the other hand, lives a double life. It is a monetary metal and an industrial metal, meaning it doesn't just sit in vaults. It gets used, consumed, and dispersed. It goes into electronics, solar panels, medical applications, specialized coatings, and the electrification backbone of the modern economy. And once silver is used in tiny quantities across millions of devices, much of it is not economically recovered. It becomes effectively gone. This is why silver can behave like a spring. When it's ignored, it looks dead. When demand tightens and inventories matter, it can snap violently upward because the market is smaller and less liquid than gold's market. A relatively modest shift in investment demand can overwhelm available supply. There's a metric people love to cite in this context: the gold to silver ratio. It's simply how many ounces of silver equal 1 ounce of gold. Historically, that ratio has fluctuated widely, but there are periods when it becomes extreme. When it gets very high, it suggests silver is cheap relative to gold, at least by historical comparisons. Ratios do not predict timing, but they highlight distortions. And distortions eventually attract capital. Now layer in industrial demand. Solar energy expansion is not a hobby. It's a global strategic priority for many governments and companies. Silver is a key input in many photovoltaic technologies. Electric vehicles use silver in various components in electrical systems. Data centers and AI infrastructure require enormous electrical throughput, and silver is the best conductor among elements. You can engineer around some materials, but you can't magically substitute the physics. Demand is not a preference, it's structural. At the same time, mining supply is not infinitely responsive. Silver is often produced as a byproduct of mining other metals, which complicates supply response. Even when prices rise, bringing new supply online takes years. Permitting, investment, geology, political risk. None of it moves at the speed of a chart. So you get the setup: structural demand pressure, constrained supply growth, and a market that can be tipped by investment flows. In that environment, silver's moves can look absurd, not because the metal is going crazy, but because it's catching up to scarcity realities. Now, one of the most counterintuitive facts that shocks people is this: there may be less readily investable silver above ground than gold, depending on how you define investable. Gold has been hoarded for centuries. It's recycled. It sits in vaults. Much of the gold ever mined still exists in recognizable form. Silver, in contrast, has been eaten by industry over decades. It's scattered in products, landfills, and low-grade scrap. That means the accessible stockpile for large-scale investment demand can be tighter than people assume. If you understand that, you understand why silver can become an asymmetric trade. If it's undervalued relative to gold and the investable supply is constrained, then a shift in perception can cause price to reprice fast. The market is not built to politely adjust, it gaps. Now zoom back out to the macro driver that ties this whole story together: confidence in paper. Modern fiat systems rely on trust. Not blind trust, structured trust, institutions, rules, credibility, and the belief that the currency will hold purchasing power reasonably over time. When that belief weakens, people seek alternative stores of value. Sometimes that's real estate, sometimes it's equities, sometimes it's crypto. Often, historically, it's precious metals. The US dollar remains dominant, but dominance does not mean invulnerability. If deficits expand, if geopolitical tension rises, if sanctions weaponize financial plumbing, if domestic politics destabilize policy credibility, then other actors naturally diversify. They don't have to hate the dollar to reduce exposure. They just have to want options. And as those options grow, demand for non-dollar collateral grows. Gold benefits, silver benefits, especially if the inflationary and industrial story emerges. This is the part where people either get defensive or get curious. Defensive people say, this is alarmist. Curious people say, okay, if big players are acting this way, what are they seeing? Because here's what matters. The largest holders of capital are not emotional. They are incentive machines. If they are consistently buying metals, it means metals solve a problem for them. Now, let's talk about the 3 near-term predictions you keep hearing in viral clips, because it's easy to get swept up. Predictions are entertaining. They create urgency. They also create risk because they encourage people to act based on timeframes they can't control. Still, there is value in understanding what would have to be true for certain outcomes to occur. First, for gold to push dramatically higher in the short term, you typically need one of 3 catalysts: a surge in central bank buying, a sharp decline in real yields, or a shock that triggers a flight to safety. Central bank demand has been strong in recent years, and geopolitical uncertainty has not exactly been fading. Real yield dynamics depend on inflation and policy expectations, which can shift quickly. So a big move is possible, but timing is always the trap. Markets can stay irrational longer than you can stay impatient. Second, for silver to spike, you need the combination of tight physical supply and a wave of investment demand. Investment demand is the variable that can arrive suddenly, often triggered by gold's move. When gold runs, it draws attention to the metal complex. Then people look for the cheaper one, and silver becomes the magnet. Because the silver market is smaller, it can move explosively once that wave hits. That is why silver rallies can feel like an elevator. They can also reverse like one. Third, for another major economy to announce larger gold purchases, you need incentives and political cover. Many countries don't want to advertise their strategy because announcing we are buying gold can be interpreted as we distrust the system. But when multiple players move, it becomes normalized. That's how herd behavior at the national level works. It's also why trends and reserves often show up gradually in the data rather than as one big headline. Now, let me be clear. None of this is a command for you to buy anything. The point of this story is awareness and analysis, not panic. Markets are not morality plays. They are risk machines. Gold and silver can surge and they can crash. They can drop 20 to 30% and then rip higher. Anyone who tells you there's no volatility is selling you comfort, not reality. What you can do, however, is stop being surprised. You can stop assuming that the world will always look like the last 10 years. You can recognize that large actors are building redundancy and alternative rails. You can recognize that gold is being treated as strategic collateral again. And you can understand why silver sits at the intersection of monetary distrust and industrial necessity. Now step back and picture the system like a room filled with chairs, because the musical chairs analogy works for a reason. For decades, the music has played. Globalization, dollar settlement, deep bond markets, predictable institutions. Everyone danced because the rules felt stable. But some players started noticing that chairs were being rearranged. Not dramatically, quietly. Supply chains shifting. Sanctions changing incentives. Debt levels rising. Political cohesion weakening. Energy and resource security returning as priorities. The choreography started changing. Tether, by stacking physical gold, is positioning itself near a chair that exists outside the traditional banking promises. BRICS, by accumulating gold and exploring alternative settlement mechanisms, is building more chairs and reserving access for its participants. Other central banks buying gold are doing the same, hedging against a world where the chair distribution changes. The uncomfortable truth is that most people only notice the chair shortage when the music stops. That's when prices gap, premiums rise, and availability becomes a problem. Not because someone flipped a switch, but because the physical market is not designed for everyone to rush in at once. So what should you take away right now from this entire hidden economy narrative? First, the actions matter more than the slogans. Watch what major issuers, central banks, and trade blocs do, not what they say on camera. Gold buying is action. Second, understand the difference between paper exposure and physical reality. There are many ways to own gold or silver financially, but the physical supply chain is where stress shows up first in a true scramble. If the story you're hearing is about physical accumulation, don't confuse that with a chart of futures contracts. Third, learn how volatility works before you place yourself in front of it. Metals can make you feel like a genius and then punish you for getting cocky. A plan matters more than a prediction. Fourth, remember that the shift, if it's happening, is likely to be uneven. It won't look like one clean headline, dollar replaced. It will look like more bilateral trade settling outside dollars, more reserve diversification, more golden vaults, and more people realizing too late that stability is a spectrum, not a guarantee. And finally, don't let dramatic storytelling replace your own verification. The facts that can be verified should be verified. The numbers that can be checked should be checked. The claims that rely on rumor should be treated as rumor until proven otherwise. But even when you strip out the hype, the underlying pattern remains. Big players are accumulating hard collateral and building optionality. If you're reading this and thinking, why would they do this if everything is fine? And that question is the point. People with billions don't buy insurance because they expect sunshine forever. They buy it because they understand probability. They understand tail risk. They understand that systems don't break at the pace of your weekly routine. They break when you least expect it. They reward those who prepared before it became trendy. So consider this your wake-up tap on the shoulder. Not a siren, not a panic alarm, just a tap. Two whales are moving. One is private, digital, and global. Stacking gold like credibility is the next currency. The other is geopolitical, massive, and patient. Stacking gold like sovereignty depends on it. Silver sits nearby, half money and half industrial lifeblood, waiting for the moment the world can't ignore its scarcity. If you do nothing else, at least stop being unaware. because awareness is the one asset you can acquire without permission. And once you see the pattern, you can't unsee it. You don't have to be afraid of it. You just have to stop dancing blindly while the chairs are being counted.